Okay, hey everyone, thanks for joining us this morning. My name's Jude Fox. I'm a wealth consultant and a CPA here at Adams Brown. I work out of our Hayes office out in Western Kansas. In addition to being a CPA, I hold my personal financial specialist designation, the PFS, which basically allows kind of CPAs to broaden their scope of expertise into areas of financial planning and wealth management, which is helpful because as a CPA, those are kind of conversations and topics that are being broached organically anyway. So let's see, I've been with the firm since 2010. I started as a staff accountant, so it's 13 years now. So my primary focus at this point is wealth management, though I'm still practicing CPA. I guess I will say that as much as I hated studying for the CPA exam, my background as a CPA and practicing in public accounting over the years is kind of, I guess it can't be understated in terms of the role that's played in making me a better advisor for my clients. So Trent, I know you're generally a very humble guy, but and this might be difficult for you, but I'm gonna ask you to go ahead and take this opportunity to brag a little bit and tell us about yourself.
Yeah, thank you, Jude. My name is Trent Woodcock. I am located in the Hutchinson office. Thanks, everyone, for joining us today and looking forward to it and getting through this. I am a CFP, which means a Certified Financial Planner designation. And so really it's understanding and going through the broad scope of financial planning for clients that we consider ourselves experts in and professionals in. So I've been with the firm for 6.5 years with Adams Brown and been in the industry 8 years. And really the move over to Adams Brown was really a really good move, understanding how much the tax and the investment management goes hand in hand. And so we're glad to have you guys here today, and we'll get started.
Hey, thanks, Trent. We're lucky to have you, man. So hopefully we can make this next hour kind of worth your time. So before we get going, I maybe wanted to do a quick agenda and highlight some of the things we want to talk about today. So of course, we're talking about tax loss harvesting and RMD planning during the webinar, but more specifically, we hope that an hour from now you have an understanding of what those things are and how they work. And with respect to tax loss harvesting, hopefully you've given some thought to maybe your personal situation, whether you would be able to kind of benefit from selling securities today at a loss to maybe reduce your current taxes in 2023. And with respect to required minimum distributions, if you have a pre-tax retirement account like a 401k or a traditional IRA, whether there's strategies that you can incorporate today or plan for in the future to help kind of reduce or minimize the amount of tax that you're going to be paying when you take money out of those accounts. So I think you'll find that there's a number of ways that you can do that, as Trent will point out later on, whether that's, through charitable giving or Roth conversions or taking distributions before you're even required to do so. So we want you guys to kind of think about your investments and whether there's things that you can take and be doing today, perhaps even before year end, that might benefit you. And I would bet that just about everyone on the call today will be or could be impacted by at least one of these two topics. Okay, so almost anyone with an investment account should kind of be considering at least one of these topics, if not both of them. So, and I guess I just would like to point out real quick that as a CPA and a financial advisor myself, that when you're coming up with a solid strategy in these areas, that it's absolutely critical that your financial advisor and your tax professional are communicating and they're kind of speaking the same cadence. Okay, you can't just go to your financial advisor and try to develop a strategy without consulting your CPA. Okay, that's a good way to get your CPA really angry at you. So your financial advisor better know who your CPA is, and they better have an understanding of what the plan is. So okay, so given my background as a CPA, I'm going to explain tax loss harvesting, and then Trent's going to bring you up to speed on RMDs. But I guess before we jump into that, I wanted to take a few minutes and kind of give everyone on the call a bit of background information on Adams Brown Wealth Consultants and what we do. And I think that's important because, what we do might differ from what you think we do or what other investment advisors do. So I don't know about you, Trent, but I find that when I'm having conversations with friends and family and people in the community about what I do for a living, and I tell them that I'm a wealth consultant or a financial advisor, invariably they want to talk about mutual funds and stocks. And they say, oh, you manage people's investments. And, while that's an important part of our job for sure, it's frankly one very small piece of what Trent and I do on a day-to-day basis with our clients. So I just want to take a moment to kind of explain how sometimes the perception of what a financial advisor does, it can be misguided, at least here at Adams Brown. So, it's more than just managing investments. So it's not uncommon for, a prospective client to reach out and seek help with managing their investments. That's what they come to us for. But, after we sit down and have an initial consultation, they quickly realize, I needed much more help than I thought I did. And so they just didn't realize it at the time. So, at Adams Brown, we kind of like to take a holistic approach to the wealth management that requires us to kind of be involved in all the various pieces of your overall financial well-being. So you can see kind of down there in that little pinwheel on the bottom right what those areas are. So one of those is investment planning and management of the investments, but there's also retirement planning and education planning, tax planning, estate planning, succession planning, insurance planning. Okay, so we think that holistic approach makes us a little bit unique in this industry, especially given how closely we work with the tax professionals and our clients. So like I mentioned earlier, the importance of having your wealth advisor and your tax professional having a hands-on relationship, not only on these two topics that we're talking about today, but really, that's almost true of any area of wealth management. So, okay, so with that, let's go ahead and jump into the topic of tax loss harvesting, which is why you guys are on the call here today. So tax loss harvesting, what is tax loss harvesting? So as the name suggests, tax loss harvesting is selling securities at a loss to offset capital gains that are owed either on those very investments that we're selling or other investments. Okay, so we know that there's years when the stock market is down. We experienced that as recently as last year in 2022 when just about every sector of the market was down. So tax loss harvesting is a way that we can potentially reduce our current year taxes by generating losses in the year of sale. Okay, and that doesn't necessarily mean that we have to wait for the stock market in general to be down either, right? So, even in a year where the market's up in like 2023 this year, right, there's still opportunities to potentially harvest losses because while investments are up, there's still sectors in the market that are down on the year. And so not all investments act in the same way. They're not all correlated and move in the same way. So there might be investments out there that you have in your portfolio this year that you might be able to sell at a loss.
Jude, I think it's important to point out that this can only be done in non-qualified accounts, not your IRA accounts. So this strategy that we're getting ready to dive deeper into, remember that this is joint accounts that you may have, a single account, or possibly maybe a trust account. So not IRA accounts.
Good point. So, and I guess I did want to point out that the timing of this webinar here in early December, it's very appropriate given the topics we're touching on today. Okay, so tax loss harvesting and RMD planning, they both could potentially require action here from you before year end if you want to take advantage on your 2023 tax return. So we're talking about a few short weeks here. So we think that this is very timely information. And I should probably also mention that I think what you'll find is that during this webinar that both Trent and myself, we're going to refrain from making any blanket recommendations. Okay, these are just ideas, strategies, possible solutions. Specific advice on these topics is very circumstantial. And so again, we're going to suggest that you speak with your advisor on these items and see if some of these strategies wouldn't be prudent. But our goal is simply to kind of get you guys thinking about these things. So, okay, so let's take a little bit, let's look at tax loss harvesting and look at it from a practical standpoint on this next slide. So how it works. So, and I know, Trent, you mentioned it earlier. So good point. We don't want to consider our 401ks or 403bs or traditional IRAs when we're talking about tax loss harvesting. Okay, so selling securities in those accounts, that doesn't generate any tax consequence until we actually distribute the money out. Okay, so we're talking about your joint accounts, your TOD accounts, your trust accounts. So those are the ones that we want to focus on when we're talking about tax loss harvesting. Okay, so step one is to make sure you know which accounts this might apply to. So let's just say that we bought a security earlier in the year in our individual brokerage account, whether it's a mutual fund or a stock or an ETF, and now it's worth less than what we paid for it. So what we can do is we can sell that security and realize or harvest that loss to reduce other capital gains that are going to be generated. Okay, and if we do that before year end, we can offset those very capital gains that are going to be paid out. And not only can we offset other capital gains, but we can offset ordinary income up to $3,000 as well. Okay, so income from your W-2 could be reduced by selling securities at a loss in those accounts, just like a contribution to your IRA would be. So we're talking about selling an investment that is down, and you might be thinking, now wait a minute, I thought the old saying was buy low, sell high, and what you're suggesting is to sell low. And here's where the third step, the replace step, differentiates tax loss harvesting from simply a sell low strategy. Okay, so it's critical that the money from the sale of the security sold at a loss is replaced immediately or shortly thereafter. Okay, so if we do that, the money has not really left the market. We've simply changed securities. And we'll talk a little bit about that more in a minute, but it's important that that third step says replace and not repurchase. Okay, we can't buy back the very same security. We just want to replace it with something else. And again, we'll touch on that in a minute. But so let's move on to discuss, some of the benefits of tax loss harvesting. And we've already mentioned, the most obvious benefit and perhaps the greatest benefit of tax loss harvesting, and that's saving taxes today. So let's put some values on this with some investments, and maybe it'll, better help us understand it. So we've got two investments, investment A and investment B. Okay. Let's just say 6 months ago, we bought both of these investments at the same time. Investment A is now worth $20,000 more than it was when we bought it. It's done really well. We want to lock in that gain. We're concerned it might go back down. So we want to sell high. We want to get out of the position. This prospective client that we're talking about in here is in a 35% tax bracket. So the tax ramifications of that sale, if we sold today, are $7,000. And so we're thinking, boy, we really don't want to pay that. And we have investment B, and investment B has done the opposite. It's down $25,000 from when we originally purchased it. And so what we can do is sell investment B today, and not only will it offset that $20,000 of capital gain that were generated by investment A, but we can also reduce our other ordinary income by up to $3,000. So effectively, we've saved over $8,000 in tax by harvesting a loss created in investment B. And in addition, what we can do with that $2,000 that's remaining, we can carry that forward to a future year where, if we have gains in future years, we can use that $2,000 to kind of offset future gains. So, there's $8,000 of real savings that were generated this year by selling an investment at a loss. Okay. And that kind of brings us to our second bullet point. So now with that $8,000 in savings that we otherwise would have had to spend on taxes, now we have more money to invest, and that allows for compounding. And over time that can, create a pretty big snowball effect. So another important benefit of tax loss harvesting is to kind of potentially reduce concentration risk. So it's not uncommon to have a stock position that maybe started off in your portfolio as 5 or 10%, and over time 10, 20 years that investment's done really well, and now all of a sudden it represents 50% of your portfolio, and maybe you feel uneasy about the risk that comes with that. But you don't want to pay the tax on the sale to liquidate that position, so you feel a little stuck. But if we can sell securities at a loss, like an investment B, it'll allow us to kind of divest of that and sell that concentrated position over time without paying any income tax. So, and that kind of dovetails into the last bullet point here, which is, the ability to rebalance your portfolio. So over time, your portfolio will naturally experience what we call drift away from its intended asset allocation. And so what we can do is we can place trades to get us back to where we want in terms of asset allocation. And a lot of times we can benefit from the losses on the sale of those securities when we do that. So a lot of benefits to potentially using tax loss harvesting, potentially none bigger than the savings on taxes though. So
Dude,
let's talk. Yeah.
Dude, I want to make a couple of points in there and jump in. Highlight a couple of things is one is the carry forward that is big, because last year we saw a lot of people take losses and generate maybe more than $3,000. And they're able to carry that into this year, when this year the market's been good. And so keep that in mind, that the carry forward can also be big from a tax savings standpoint into the next year, not only the current year. And the other thing I wanted to say, when we talk about selling stocks or mutual funds, and sometimes we look at it stocks, is you don't have to sell the whole position to tax loss harvest. Let's say you bought ExxonMobil for, you put $10,000 into it 5 different times between 2010 and 2015. And you don't have to sell off the whole position. You can sell off to just create a loss. You can sell off a smaller portion, and it's called selling by lot. And so some of those shares purchased might have a bigger loss. And so you can, if you work with your advisor, you can go in individually and just sell off those specific shares and still keep your Exxon because you really like it, but maybe you want to go pick up, I don't know, Chevron or Phillips 66.
Yeah, good point, Trent. A lot of times I'll have my clients say, hey, I have an unrealized gain in this position. My cost basis is 10,000. The current value is 15,000. We can't harvest any losses. But to your point, if we drill down on those individual lots, oftentimes there's lots that we can sell at a loss, even if the overall position is in a gain position. So good point there. Okay, so let's talk a little bit about what we call the wash sale rule and how that can potentially throw a wrench in the strategy if we're not careful. So, earlier I mentioned how it's important that we replace and not repurchase a security when we're tax loss harvesting. And so let's talk a little bit about that in more detail, so you kind of understand a bit better about how, messing up this part of it can be fatal to the strategy. So the wash sale rule is designed to prevent investors from claiming a tax loss on a security if they buy the same or substantially identical security within 30 days before or after the sale of a security at a loss. And so why is it that we would have such a rule? Well, prior to the wash sale rule, investors were generating these, what I'm going to call artificial losses, by kind of selling securities at a loss and then immediately repurchasing them. So really nothing changed. They're in the exact same positions as they were previously. They're just generating these artificial losses, and the IRS didn't like that. So they created the wash sale rule in the 1920s, and over the years, Congress has kind of, made some tweaks to the rule. Originally it was just that you couldn't buy the same security. And then in the 1950s, they changed it to substantially identical security. And so what that means is that you might buy a different security with a different ticker, but if they're highly correlated, you might get tripped up and that loss be disallowed. And so you won't even necessarily know that until you get your 1099 at year end. So we want to be careful about that. I don't think I want to get too technical into what constitutes substantially identical, because frankly, it's not very clear. And I think it's also probably above, the purview of this webinar, but, suffice it to say that you've got to be careful when you're choosing that replacement security, so your loss isn't disallowed. So, and the IRS has kind of cracked down on this recently. In 2013, they made it so that to help better enforce the rule, they required the brokers to start reporting the wash sales on the 1099s. Okay, so if you have an E-Trade account or a Charles Schwab or Fidelity account, those brokers are tasked with reporting those transactions that fall under the wash sale rule when they report your securities activity for your year on your 1099. So, okay, so let's just be careful with the wash sale when we're talking about the replacement of your security. We don't want to get tripped up by that and disallow any losses that we thought we were harvesting. So,
Jude, it's important to point out that it's not only stocks, right? We can do mutual funds, you can do ETFs, you can do this, you can capture this loss, and then you can, if it's a mutual fund and it's a large cap mutual fund, you can take your money and move it into another mutual fund. And so keep that in mind. And we always talk stocks, and we give the example, hey, you really want to own a soft drink, and you own Coca-Cola. And so you sell Coke, you capture your loss, and then you can turn around and buy Pepsi. And you just can't, you got to wait that 30 days before, if you really like Coke, hope it stays down, hope the price stays down. And then 30 days later, maybe you get lucky and you get to buy it at a lower price. But just remember, don't do it within that 30 days.
Good point. So last thing I want to touch on regarding tax loss harvesting is to kind of briefly differentiate the different types of capital gains and how that will influence how they're taxed. So when you sell a security in your brokerage account, they're classified either as short-term or long-term. And as the name implies, the length of time that you held the security before selling differentiates whether it's deemed short-term or long-term. Okay, so if the time between purchase and sale of the security is 1 year or less, it's deemed short-term. And if it's held for more than a year, it's long-term. And that differentiation matters significantly with respect to how you're taxed on those transactions. So if they're short-term transactions, they're taxed at the same rate as your ordinary income. So as you can see on the top half of that chart on the right, it's dependent upon your other sources of income, of course, but you could be taxed on those short-term gains on a rate as high as 37% potentially, okay? Whereas with long-term transactions, they're taxed at a little bit more favorable rates. And that's what you can see there on the bottom half of that chart. So, 0%, 15%, or 20%. So the highest rate you would pay on those transactions would be 20, but could be as low as 0. So one other thing I do want to touch on briefly is that, while tax loss harvesting makes a lot of sense for clients that, they might have significant other capital gains, there's instances when instead of harvesting losses, maybe it makes sense to harvest some gains. And so, when might that be? Well, maybe we can harvest some gains and we can do it while being in that, 0% long-term federal tax bracket. So effectively, there's opportunities potentially where we can realize gain and pay no federal tax while doing it. Okay, so maybe you're a business owner and for whatever reason, you had some obsolete inventory, or you're a farmer and income's down because it hasn't rained in forever. So there might be opportunities to harvest some gains and do it while paying no federal tax. So, I think the main takeaway here is that, careful attention to detail within your brokerage accounts can kind of present some opportunities to take advantage of the rules that could, ultimately result in some tax savings for you. But, it takes an understanding of the rules. And like we mentioned before, it takes good coordination with your tax professional. So I guess I would encourage you guys to think about your own investment accounts and give thought to whether, harvesting some losses or harvesting some gains might benefit you here before year end. So, okay, Trent, let's
Jude,
switch.
I want to
Jude.
I want to sum up just a couple things. I think Jude was was right, that if you're going to look at this strategy, you better, and you're going to do it yourself, you better know what you're doing and understand the tax ramifications, or your advisor better know what they're doing, and your CPA coordinating together. And I think that's important, because this can, again, we stress this can be a very beneficial tool for you to minimize that tax. And that's what we try to be sure that we want to, do for you as an advisor. And the other thing, that we never want to put our clients in, we never want to see them lose money and put them in bad investments, but the market goes up, the market goes down. And so if you aren't taking advantage of this strategy in those down years, then you need to get with your advisor, or talk to another advisor.
Yeah, so good point, Trent. So okay, so let's switch gears. Trent, I've been hearing a lot about required minimum distributions in the news. My clients have been asking me a lot of questions about whether this applies to them. I guess, what do we need to know? Set us straight on this.
Yeah, I think a lot of you maybe have heard the acronym or seen it, required minimum distribution. If you're in that little bit older age in retirement, right, that you're that you're going to have to take your money out of your IRA accounts at some point, at some age. And so I think whether you're 45 or 75, this is good to go over of how these required minimum distributions work, and some strategies that we use as advisors that we'll touch on here towards the end, that also, again, can be beneficial for you. So again, any tax deferred retirement account you're going to be required to take out that minimum each year. And so the first thing is, when do I need to start taking RMDs? And now it is age 73. It used to be 70 and a half, and a lot of you might be familiar with that if you've already started. But now, because of the Secure Act 2.0, it is bumped up to 73. And if you see the chart there on the right, it's actually going to jump up to 74 if you were born between 1967 and 59, and then anybody born after 1960 will be age 75. And so be thinking about that as you hit retirement or near retirement, what kind of bucket you have in tax deferred money, and then what that RMD is going to be. And again, there can be some strategies to minimize that, or again, to lessen the tax. And so one of the things, the last point, is the required beginning date. This isn't done often, but just to let you know it's out there. The very first year that you have to take a minimum distribution, that RMD, you can actually delay it until April 1st of the following year. So for example, if you turn 73 this year, today, and you have to take out that minimum distribution, you can actually defer that until before April 1st. But what you then have to do is take out that RMD again before year end in the year you're 74. And so again, we don't see it often, but it is out there, can be utilized for that first year of the required minimum distribution. Okay, what accounts do I need to take an RMD from? And so any account that you have that is going to have IRA next to it that doesn't say Roth is going to count. And any 401k that you have, 403b, 457 profit sharing plan, any account that you have been able to defer that tax on, there's going to be an RMD that's going to be calculated. Okay. If you have Roth, this is the great thing about Roth IRAs, Roth 401ks now, that Roth does not have a minimum distribution. That money is growing tax-free. And it's important to point out that starting next year, if you have a Roth 401k, you do not have to take out an RMD. If you didn't know it, this year and previous years, if you kept your money in your 401k, you retired, and you you didn't roll it into an IRA, you still had a minimum distribution. But again, coming back to the Secure Act, that is going to change for next year.
Brett, I think one other thing worth maybe mentioning is that, it's not uncommon for a client that might be of RMD age to still be working. And so, maybe they love what they do, so they work well into their 80s. Well, if you're an employee and you have an employer sponsored plan like a 401k, a traditional 401k, or a traditional 403b, if you're still working, as long as you own less than 5% of the company, you do not have to take out a required minimum distribution. Okay, so it's called the still working exception. So as long as you're working, you don't have to take money out of that account.
That's a good point, Jude. And the thing to also think about is, though, if you have a separate IRA and you're of age and you still have your 401k and you're working, there's still going to be an RMD on the IRA, just not the 401k. Okay. All right. How are RMDs calculated? You get this number that your advisor tells you need to take out by year end. And so the IRS has a table that they use that has a distribution factor that they look at your age when you hit that RMD and then divide your balance by that. But what they do is they take your balance of your IRA account on January 1st. And so January 1st of this year, 2024, you'll look at your balance and then you'll be able to calculate, or will be able to calculate, your RMD and know what you need to take out. So for example, if you turn 73 next year and you have a $500,000 IRA and the balance is on January 1st, you're going to divide that by 26.5, and then your minimum distribution next year would be $18,867 and change. And so that's kind of how that works. And so there's different tables based on different scenarios, but we're not going to get too deep on that. This is your IRA as owner. And the other thing is, if you have multiple IRA accounts, 401k accounts, the IRA accounts can be aggregated together to figure out the RMD, and the RMD can be taken from one IRA. It doesn't have to be taken from each IRA. Okay, so some people, we see them do that strategy where they have 2 or 3 different IRAs. And the thing is, though, if you still have a 401k, the RMD does have to be taken out of that 401k. That company plan, if you've left it there and haven't rolled it into an IRA, that does have to be taken out. You cannot count that together with your other IRAs. So make sure you're hitting that minimum there.
Trent, real quick, we had a couple questions and I didn't want to forget them. So real quick, will you please review the date that an individual is required to take an RMD? For instance, if you were born on January 12th of 1951, when must you take the RMD? Okay, can we back up a couple slides to that, the dates?
That's a good point, or a good question. And so you have until January. You have until December 31st to take that required minimum distribution out in that year you turn age of 73. You don't have to wait till after you turn 73. You can do it January 1st or January 2nd, but you do have to have it completely out by December 31st. Or again, that exception rule of the first year, you can extend it out that next year if you'd like.
And then one more question was, do you have to be working full time? I assume that's in relation to the still working rule. Trent, I don't know if you know that. I believe that part-time would still allow you to not have to make your RMD.
You're right. As long as you are eligible for the plan and you're meeting the minimum plan requirements and to be in the plan, then you do not have to take that RMD and you're still working.
Good question.
Okay. Should be taxation on RMDs. when you take that money out, it's not like tax loss harvesting and it's taxed at capital gains rate. This is taxed at ordinary income. And so you're in the year which you're going to take that out, then it's going to be counted towards income. Okay, just along with interest and added up, and maybe your Social Security. And so think about, again, it comes down to some planning of thinking about how much is my RMD going to be? Is that going to jump me up into another tax bracket? And just being cognizant of what that amount's going to be and how it's going to affect you tax wise. And especially then, what we see sometimes is, maybe one spouse starts before the other, and it's not a big burden, but all of a sudden both spouses start a couple of years later and they're in another tax bracket. And so that just keep in mind of it is taxed at ordinary income.
Yeah, Trent, and I guess one thing I would point out is that, a lot of my clients will say, maybe they have a 401k at work and they say, well, I've been putting all of my contributions in on a Roth basis. So, I won't, none of that money will be taxable coming out. And while that's partially true, just keep in mind that if you're eligible for any employer matching contributions, right, those go in on a pre-tax basis. So just because you're putting all your money in on a Roth basis, if there's any amount going in, whether it's profit share or match from the employer, that will be taxable when it comes out.
Yeah. And a couple things that I've seen that I've worked with clients on is they've had a large purchase. They're at that age that they have RMD, and they know maybe they need to replace their vehicle and they want to buy it at year end. So instead of taking a large lump sum out in December and they've already met their RMD, stretch that out over 2 years and say, hey, can I get by? And can I, let's take out 20,000 today. I met my RMD, and then let's take out 20,000 January 5th. I'll pay off the vehicle in whole, and I've met my RMD for both years. So there's strategy that can be worked with the RMDs. Okay, penalties. If you forget to take out your RMD and the years are flying by, and I 73 went right past and now I'm 75, and your advisor dropped the ball and didn't talk to you about it, which we would never do, hopefully. The penalty has been reduced. What used to be 50% is now 25%. And possibly we have in the rules there even 10% if the RMD is corrected within 2 years. And so just keep that in mind, that if let's say, for example, you had a $10,000 RMD this year and you forget, and next year you remember, go back and correct it as soon as you can, get with your CPA, and there's a good chance you can avoid the penalty. But if that penalty does come down to it, you have to take out an additional 25% and then pay the tax on that. So the penalty has lessened down to that 25%. But again, it's important, correct it as soon as you can, get with your CPA, get with your advisor, and there might be some workaround to minimize that. Okay, 3 strategies we want to look at with that RMD that I talked about that we use for clients, that Jude has used, that I've used. And the first one I really, really like, and it is qualified charitable distributions. QCDs is the acronym, another acronym, right, that we use. RMDs, now QCDs we're throwing at you that we use. And what the IRS has said is that if you have an RMD you have to take, if you want to avoid the tax on that, you can send it directly to a charity of your liking, and then you don't have to pay the tax. Okay, and this is huge, since standard deductions went up a few years ago, and people aren't itemizing. And now, if you can take advantage of this QCD, it's big, and you don't have to do the full amount. So again, I come back to the example is if you have a $20,000 RMD and you want to give $5,000 to maybe a church or a charity or Red Cross, you can do 5,000 and then you can take the other 5,000. And you can also do multiple charities. You don't have to do just one. You can do it. There's a lot of flexibility here. That's the thing to remember with this QCD. And I do this for a lot of clients. You can do it quarterly, semi-annually. Again, get with your advisor and plan out a strategy. The thing to remember is the money cannot come into your bank account and then you write a check to the charity. It has to be directly from the IRA. The check will be made payable to the charity and then you deliver it.
My clients sometimes struggle with this. They say, I'm already giving to the church. And what they don't realize is, in that example that you provided, where you've got a 20,000 RMD, and if you take that out, maybe after taxes, you're left with $15,000. And you take that $15,000 that's left, and now you go give it to the church and the various organizations. When instead, if you had just sent it directly to them, you have $20,000 to give and not 15. So it's not whether or not you're already giving, it's that instead of taking it from your checking and giving it to them, let's give it directly from your IRA and save tax.
Yeah. Good point. Is there's a method to it, and make sure you're following the rules and doing it the right way for it to be counted as a QCD. So next strategy that we're going to look at is Roth conversions. Okay. This one we also do, not quite as common as the QCDs, but again, if you understand the Roth and how it works with that tax-free growth, and there is no required minimum distribution, a strategy that we look at with this Roth conversion is maybe you retire at 66, full retirement age, and you have 7 years now until you have to start taking RMD, and you have a large sum of money in your IRA, and your RMD is going to be pretty big. You also retired, and maybe you're in a lower tax bracket. And so what you can do is you can take 10,000, pick amount, work with your CPA on this. You can convert a lump sum of money from your IRA into a Roth account, pay the tax on the conversion that year. There's no penalty. Pay the tax on it. And then what you've done is you've lessened your RMD for later. Now you have money in a Roth account, and you've taken advantage of tax brackets of that. Hey, I have another 20,000, 30,000 that I can fill in this tax bracket at 12% maybe. And it's a win-win. And it's a good strategy that we use, that we look at, that people kind of often overlook with this Roth conversion.
And I guess just to point out, I know you know this, Trent, but the expectation with respect to tax rates in 2026, when the Tax Cuts and Jobs Act expires, is that they're going to go up. So, now is a really good time to consider Roth conversions, because we don't think you're going to be paying at a lower tax bracket once the TCJA expires in 2026.
Yeah. And one other thing to point out with that Roth conversion is, if you hit 73 and you still want to do it, you can, but you have to take out the RMD first. You can't use your RMD and count that towards your Roth conversion. It doesn't work that way. You have to take out your required minimum distribution first and then do the Roth conversion. So it can be done later on. Just we see it best used in those early retirement years. Okay, third strategy, and we're getting close to wrapping this up, guys. So we don't see this as often, is just taking starting distributions early. And again, it kind of comes back to the strategy of the Roth conversion, but maybe you don't want to convert it to a Roth, and maybe you do need the income, and you want to start taking some money out of that IRA at 66. And So it's, again, working with your CPA advisor to minimize the tax, to start taking those distributions early to minimize that RMD at 73, 74, but one of the more efficient ways that we've seen this done is working with Social Security. And so again, if you're getting ready to retire 65, 66, and you're trying to figure out, hey, do I start Social Security? Do I not start Social Security? Do I take distributions from my IRA? It's again, there can be some planning that can go into it that you definitely want to look at, because maybe you do start taking distributions early and pay that tax, and you defer your Social Security to let that increase by that 7.5%, 8% each year, and try to get to 70 before you start Social Security. So again, with that strategy, just be aware that it's okay to take RMD, or it's not an RMD. It's okay to take distributions early. Just, understand, hey, there's taxes to be paid on it, but how can I benefit this myself in other areas? Okay. We've talked about two different strategies here, and tax loss harvesting and RMD planning. And we both, you can tell Jude and I live and breathe this, and really, really like working with clients when we can strategize around both of these areas and help clients out. And that's what brings us, that's why we come to work every day, to make you guys, the clients, make them happy, and make sure you guys understand things, and hopefully maybe we can save you a little money. And so just remember, it's probably best if you're talking with somebody and understanding, how it's going to impact you with both strategies, and talk in advance. If you're going to do tax loss harvesting, don't wait until December 25th and say, one, your advisor's not going to be working, or I'm not going to be, but it might be a little bit too late. So do that in advance. And so I know it's a busy season this year. You got 19 days to get your Christmas shopping done. Thank you for joining us here today. If you got questions, please start entering your questions now in the queue. If you have any other further deep questions that are a little more personal, you can get with your individual advisor. If you don't work with one, you can call an Adams Brown office and get with one. Remember, Jude's in the Hayes office. I'm here in the Hutchinson office. And this concludes our presentation. We thank you. We're still going to go through some questions here, so hang on tight. And again, thanks a lot today for being here. So, Jude, first
we got
couple questions.
Things. Yeah,
we
got a couple. I guess more of a comment than a question, but one is just that I work for a college, and these QCDs are very helpful, and the client receives a receipt from the college for their tax purposes. So, and I guess that brings up a good point. When we're doing a QCD, the way that it works is the check will be made out to the college or the 501c3, whoever it is, but it will come to you so that you can take that check in and get credit for it. Because otherwise, sometimes they don't know where the money comes from. So the check generally comes to you, but it's made out to whichever the 501c3 is.
Yeah, good. Thank you for that comment there. And that so next one, can QCDs only be used from IRA accounts? They can't be made. Can they be made from 401k accounts or regular investment accounts? The IRA accounts only, and not even Roth. And so remember that it's any tax deferred account there, your 401k account. That's why we always encourage people to roll out their 401k. You left your employer. It's maybe not always be in your best interest to leave your money with your employer. Take it to yourself into a personal IRA, and then you can use this strategy.
Good question. Another question is, will this be posted to review later? Yes, we will. We'll have it. This is recorded, so we'll send the recording and the slides out either today or tomorrow. So, yep, we will follow up with that. Let's see. Could you review how we can access this recording after the meeting ends? Okay, took care of that. If you have IRAs, 401ks in different places, and you are working past your retirement age, sufficient hours to qualify for that retirement plan, is there any RMD required from the other accounts? Okay, so good point. We talked about the still working rule, and a client might be 75 years old and they're still working at their job. They have RMD requirements. They have an IRA and a 401k. You don't have an RMD requirement in your 401k that you're working for, okay, that employer sponsored plan, but you do have it for your IRAs. So any retirement pre-tax money that is not in an employer sponsored plan would still have an RMD requirement, even if you're working. Okay, so it only applies to the 401k for the company that you're working for. Good question.
All right, another good question. Who do you contact first to do a QCD? So I'm going to say your advisor, and you don't, if you want to go to the recipient that's going to receive the money and you want to let them know that you're going to do the QCD, by all means, you can do that first, but it's going to be getting with your advisor because there's going to be paperwork to probably be filled out. You're going to have to get the name, the address, who that's going to be. Because the way we work here with Adams Brown Wealth Consultants is, and I know not everybody's the same, but we have the checks. It's a physical check that's mailed directly to the client, to you. And then it's your responsibility then to deliver the check to that recipient who you want it to go to. And so the other thing to keep in mind with these QCDs is when you receive that 1099 in January, February, be sure that you let your CPA know that you did a QCD. It might not always be caught that this QCD was done because you definitely don't want to do this and then pay tax on it. So keep that's very foremost in your tax preparation, tax planning, that you get this, that they're aware of the QCD.
Yeah, good. So agree 100%. First, reach out to your advisor. Almost always as advisors, we reach out to the CPA first of all, just to make sure that there's no reason that this wouldn't be prudent. But secondly, for the reason that Trent mentioned is when they get that 1099, there's nothing on it that will denote that you did a QCD. So it's absolutely critical that we let the CPA know that we did a QCD for our RMD for that year. And I guess one other thing I want to mention is if we're talking about getting a QCD done for 2023, you need to act immediately because that process is a little bit more involved than just a regular distribution out of your account. And so the clock is ticking. Get started on that today.
Hey, Jude, one thing I wanted to point out on the QCD that I left out of the presentation is you can start that at 70.5. You don't have to wait until 73 of that required minimum distribution. So that's kind of a nuance. Since the age changed to 73, they left the QCD age at 70.5. I'd like to see it drop to 66 or 67, but for now it is 70.5. You can start that QCD. So again, another strategy, you can start early, not waiting until 73. Okay, next question. For tax purposes, can you do a QCD? There we go, before it is required. I just kind of answered that question. You cannot do it before 70.5, unfortunately. It starts at 70.5.
So one thing, a point of clarification that I don't want anyone to get tripped up on. You can't, if you're going to turn 70.5 in 2023, you can't do it before you actually turn 70.5 years old. So if you're going to do it, make sure you do it after you've literally turned 70.5 years old.
All right. We'll give you a little more time for questions, but again, if there's any further questions that would come up or more direct questions, please reach out to somebody. We are really, really happy to have you on board here today and join us. And to everyone, have a Merry Christmas and a great New Year. And